You can feel it, right? The world just seems more unpredictable lately. And, these aren't just headlines you can scroll past anymore. These are major seismic shifts that are hitting the markets and your money directly. So let's get into it and figure out how to navigate this whole new, kind of turbulent financial world.
And look, this isn't just a hunch. The World Economic Forum put it plainly. This isn't some temporary storm we can just ride out. This constant state of change, well, that is the new normal. So what does that mean for us as investors? It means the old playbooks, they might not cut it anymore. We really have to start thinking of volatility as a permanent feature of the landscape, not some temporary glitch.
For decades, we got used to a certain way of things. This era of globalization, what they called the peace dividend. The idea was that if everyone was trading with everyone else, major conflicts were less likely. Well, that era is pretty much over. What we're seeing now is a world driven by competition between major powers, where national security is the top priority. And that's creating a world that's a lot more fragmented and, frankly, a lot more unpredictable. Okay, so the big question is, how does all this high-level political tension actually hit your wallet? How does it affect your portfolio? Well, it really boils down to three core disruptions. These are things that are fundamentally changing how money and goods move around the planet. Let's break them down one by one.
All right, first up, the supply chain scramble. For years, the name of the game was all about efficiency. You remember just-in-time delivery, right? Get parts exactly when you need them, no sooner. But all these global conflicts have really exposed just how fragile that system is. So now the buzzword isn't efficiency anymore, it's resilience. Companies, even entire countries, are now willing to pay more just to be sure they can get what they need, even if it's not the cheapest or fastest option.
And this isn't just theoretical. I mean, look at the very real costs of something like the Red Sea crisis. Suddenly, ships are being rerouted all the way around Africa. That adds thousands of miles. Freight rates have shot up and stayed there. And war risk insurance? It went through the roof, from $10,000 to $500,000. It just made that route totally unworkable for a lot of companies. When you add it all up, you're talking about a $15 to $20 billion a year problem. And that cost? It ends up fueling inflation and squeezing profits for everyone.
Yeah, when you see an image like this, it really hits home, doesn't it? Every single one of those containers is part of this massive global dance that's been completely rerouted. It's no longer about finding the shortest path from A to B. Now it's all about finding the safest path. And that one simple change, it affects everything, from shipping schedules all the way down to the price you and I pay for pretty much everything.
Okay, disruption number 2 is what's being called a new tech Cold War. We're talking about this intense strategic competition between the US and China, specifically over who's going to dominate critical technologies like advanced chips and AI. Now, it's not a complete split, it's more of a selective decoupling. Basically, both sides are racing to build up their own capabilities in these key areas so they don't have to rely on each other.
And you can see the results of this split pretty clearly. On one hand, you have the US trade deficit getting deeper, but at the same exact time, China's trade surplus has ballooned to a record high. So even with tariffs from the US, China has managed to just reroute its exports. They're sending more goods to other parts of Asia and to emerging markets, and it's creating these two completely different economic stories.
Which brings us right to our third big disruption, this huge wave of protectionism. Things like tariffs and trade barriers, they're not just economic tools anymore. Now, they're being used as key instruments of foreign policy. Get this, in 2025 alone, more than 3,000 new trade and industrial policies were put in place around the world. What's happening is that governments are actively stepping in to pick winners and losers, all in the name of national security and propping up their own domestic industries. So, let's recap. We've got a more fragmented world, and supply chains are under a ton of pressure. Now, that definitely creates risk, but it also creates some massive opportunities. So the real question is, in this new reality, where is the smart money going? Let's take a look. Well, research from JP Morgan points to 3 really powerful themes. Number 1, defense. That peace dividend we talked about, it's gone. Nations are rearming. Number 2, power. Think about the explosive growth of AI and data centers. That is creating an absolutely insatiable demand for energy. And number 3, supply chain independence. This is fueling a huge push for domestic manufacturing and automation, bringing it all back home, basically. And the proof, as they say, is in the pudding. I mean, just look at the performance. That bar on the far right, that's a group of European defense stocks. And in 2025, they delivered returns of over 100%. That is not a fluke. It's a direct result of what some are calling conflict capex.
as European countries ramp up their military spending in a big way to respond to threats in their own backyard.
And the sheer scale of this spending, it's just staggering. For example, the Trump administration has floated a proposal for a $1.5 trillion dream military budget in the US. And this isn't just about buying more tanks and planes. A huge chunk of that money is aimed at next-gen tech like AI, autonomous systems, and advanced missile defense. That's a massive catalyst for the old-school defense companies and for the new tech players, too. So with all this uncertainty floating around, it's no surprise that investors are also flocking to traditional safe havens. JP Morgan actually has a forecast out there that gold could hit over $4,700 an ounce in 2026. And this isn't just small-time investors buying coins. This is a big structural shift being driven by central banks, especially in Asia, who are actively trying to diversify their holdings away from the US dollar. Okay, so this is the crucial part. How do you take all of these huge global trends and actually translate them into a concrete plan for your own portfolio? Let's walk through an actual framework you can use to check your risk and maybe reposition for what's coming. You can actually start with a pretty simple 4-step audit. First, just identify your exposure. Ask yourself, which of my investments rely on those fragile, long-distance supply chains? Second, analyze their revenue. Where is their money really coming from? And how vulnerable is it to tariffs or some regional conflict? Third, you gotta stress test it. What happens to your portfolio if a trade war gets worse or a new conflict breaks out? And finally, fourth, evaluate for resilience. Start actively looking for investments in companies and sectors that are actually set to benefit from this shift towards localization and security. And really, this means we have to rethink how we build a portfolio in the first place. You know that classic 60-40 stock and bond mix? That was designed for a world where things were pretty stable, where stocks and bonds moved in opposite directions. But now, we're seeing them both sell off at the same time. So a modern, resilient portfolio, it needs to be built for this new, fragmented world. That means bringing in assets that don't move in lockstep with everything else, things like infrastructure or certain hedge funds, which can zig when everything else zags. Ultimately, to really thrive in this kind of environment, you need to have a dual focus. On one hand, you've got to be agile enough to react to things as they happen, to breaking news. But at the same time, you have to keep a long-term strategic view. Because, let's be honest, these big geopolitical trends, they aren't going away anytime soon. It really comes down to staying informed, being adaptable, and having a bit of patience. So, I'll leave you with this one question to think about. In an era where tension seems to be the new normal, is your portfolio actually built for resilience? Or is it still resting on the relics of a world that doesn't really exist anymore?